Welcome to the Money Over 50 podcast, brought to you by Dallas Davison and Michael Hogue from Money Over 50 Financial Advisors. This information is general in nature and does not take into account your objectives, financial situation, or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Money Over 50 Financial Advisors. Here are your hosts, Dallas Davison and Michael Hogue.
Welcome to Money Over 50. Today we've got a listener question. Michael, do you want to do the intro?
Thanks, Dallas. Yeah, the email came through from Darren. Darren says, "Hi guys, love listening to your podcast. It's better than meditation."
My wife would say it's more boring than meditation. But
Darren goes on to say, "I was wondering what the nuts and bolts at day dot of retirement are when you reach an age or a given amount. Specifically, 3 questions. How is income normally distributed? How does the pension fund work? And do you constantly need to sell down shares? Thanks, Darren." So I thought we'd do a basics one on this because it didn't occur to us that, of course, the curse of knowledge.
Yes.
It doesn't occur to us a lot of the times that people do have
we talk a lot
certain
about
specific questions about the inner workings of something. So
we talk about the pension account a lot as it's the holy grail of where we want to get to. We sort of talk about it as Darren said here, as the target and as a goal to get to this point with X amount of dollars in a pension account, but we haven't really gone into the specifics of how does the pension account work? Practically, how do you actually draw that income day to day? Those sorts of things. So good question.
So naming, first of all, I think the naming is confusing.
Yes.
However, we have to go with what legislation calls things. So the correct name is an account-based pension.
Yeah.
Where I think it's confusing is that the word pension is always forever and a day denoted Centrelink's involvement.
Yep.
Centrelink don't have any involvement in this other than you have to report the values to them if you are getting a part pension, part age pension or a part full pension. Now, what's also confusing is that an account-based pension is a type of superannuation income stream. We actually prefer the word superannuation income stream because we think it describes it better. It's a superannuation fund that you have met your preservation condition of release, and we'll go into how you would meet that later on. But and effectively, you move your superannuation fund, which most people understand to have an account balance that tends to fluctuate depending on in the short term, at least, in investment market movements. That gets moved into a account-based pension or a superannuation income stream. Most of the time, it has the same branding on it, so you don't even know. Most people don't actually even know unless they look at the fine print of their statement. So if you're with Q Super, then
sometimes they will automatically move you across, and sometimes they won't. But if you're with if you've got a Q Super account, once you've met a condition of release, if they have done that for you, if you've done that, you can move that into an account-based pension. It's still Q Super branded. It's often the same investment strategy, the same underlying assets, all that kind of thing.
Sorry, go ahead.
No, I was just going to say, I think the other confusing thing about the terms here, the account-based pension or the superannuation income stream, even that term, it sort of denotes or implies that the word pension, I think the only other phrase that people think of when you think of pension other than Centrelink is like a private defined benefit account where you work for if you were in the army for 20 years and you get a pension for life. It sounds like it's a set dollar amount every year until the day you die.
Yes.
And that's not how it works. And that's, I guess, why the name is an account-based pension, is that it's you can draw an income out of it. You can draw a regular amount out of it, but you can only draw an amount out of it while you've got money in the account, if that makes sense.
Yeah, absolutely. Yeah. So, think of it like a bank account. Yeah. Think of it like a bank account that can run out.
Yeah.
We talk about 2 numbers that matter a lot in retirement, and we spoke about the green number, which is what is your What does your money that you have earn you or return for you every year? Mm-hmm. And the red number is what you take as an income. And we speak about, as long as that green number, what your rate of return is higher than the red number, your account balance will grow even though you're taking money out. But think of it akin to a bank account. If you overspend, if you spend more than the money going in and the original account balance, it will start to run out.
Yep.
So now what's confusing, there's other marketing names that product providers call these account-based pensions, such as a retirement income account, an income account, and there are various different others. But when you read, the trick is to read, if you see retirement income account and you're wondering what you need to look up is the product disclosure statement or the PDS, and it will, if it's an account-based pension, it will state this is an account-based pension. So now to open one of these, so one of Darren's question is at that point in time when you retire,
when you reach age or given amount,
how does this actually happen? So there are what they call conditions of release to superannuation. So you have to meet a condition of release, which in layman's terms is having access. People say that being able to get access to my superannuation. That's a condition of release. Now you have to meet a condition of release in order to open up an account-based pension. The common ones are here. Mm-hmm. I'm writing another one down as we speak because I neglected to write it down. But the first one is you've met your preservation age and you've permanently retired. So you can currently be as young as 58, age 58. So if you're born between the 1st of July 1962 and the 30th of June 1963, you are either age 58 or the youngest you could be is 58.
Because that number used to be 55.
Used to be 55.
And now the limit has been pushed out to 60, but there's those grandfathered in rules where it's basically every year that age has sort of gone up by a little bit.
And it's approaching 60. So by the time we get to 2024, it will be simpler because it will all be 60-year-olds. So the first there is a unique little window here though. So someone that's currently aged
right now,
58, and if you were born between the 1st of July 62 and the 30th of June 63, you could be. We're recording this October 2021, so you could technically be 58. You could retire. I had a client do this earlier this year, so he had sufficient funds to be able to retire fully, and he said, "I'm retiring." So he retired at 58. He met a condition of release. You have to sign documentation to say that you are permanently retired and have no intention of returning to the workforce. And he was able to move his superannuation into an account-based pension. The other common condition of release is that if you've attained the age of 60 and an employment arrangement under which you were gainfully employed has come to an end. So if you cease
an employment arrangement,
misconception here is that you don't have to be fired. So you could just voluntarily cease that arrangement,
and it doesn't have to be. This is the difference between this one and the first one, is that you don't have to stop work and never intend to return. You could just change jobs, basically.
You could change jobs. I mean, technically,
you could have 2 jobs.
You could take a part-time job at McDonald's. Like the way that the legislation reads. You could have your full-time jobs. You could take a part-time job. Which is an employment arrangement for gainful employment. You could cease that. And technically, you would
access an account-based pension.
Effectively be able to meet your condition of release and access an account-based pension.
This one's a really interesting, or it's a bit of a trick when we come across it, because you often have people who are working towards retiring at 65. But if this is the case, if they've changed jobs when they were 61 and they're often coming to us for the first time at 62 or 3, and they'll say, I started this new job 18 months ago. And you often look back, and as long as they've met that criteria, they can get into an account-based pension, and we'll talk more about the benefits of why they would do that. But even though they're still working, they still intend to work for another couple of years. So that's a pretty handy one.
I have a couple who are clients, and the male is very employable, but he chops and changes jobs a lot. Adam, if you're listening. He works
the way you had to clarify that he's very employable. He chops and changes not because he keeps getting sacked all the time, but because he changes.
He works in health and safety in mining and related services. So he turns 60 in January.
Yeah,
he's resigning.
Yeah,
like the day after he turns 60, he's resigning from his current job.
Yeah.
And just so he can meet a condition of release, and then he'll be able to find work the following day because he's very employable.
Yeah.
And the benefits that we'll go into in a minute is he'll be able to move his superannuation into 0% tax, and that's the main benefit. You're moving from a 15% tax environment to a 0% tax environment. I'll touch on that a little bit, but we'll finish off here anyway. So the difference between those first two. So if you met the first one, so a 58-year-old right now, they would have to say that they have
never intend
to return to work.
Yeah. It's actually, if you don't intend to return to work for 10 hours or more per week.
10 hours or more per week. Yeah, you looked into that. The second one is much easier. So you've attained the age of 60 and you've just ceased
an employment
arrangement for gainful employment.
Yeah.
And therefore you've met that. The other common ones are permanent incapacity.
Yeah. So if you can't ever work again.
And attaining the age of 65.
Yep.
So
regardless of your work condition, whether you're still working, not working, ceased work, not ceased work, once you reach 65, you can move into account-based.
I met some new prospective clients just last week, and he turned 65 on Sunday. So we said, and he was still working.
Yeah.
He still plans to work for a little while.
Yeah.
So so I said, from Sunday, you can effectively take advantage of moving your superannuation, which is currently being taxed on the income that it earns internally at 15%. You can move that into a 0% taxed environment.
And so that flows very neatly into the next point here, which is why do we keep talking about how good it is to be able to access an account-based pension, the benefits of that. So you've just touched on the main one there is that the tax on the earnings or the rate of return. As we just said, the money that goes into an account-based pension, it's the same as your superannuation fund. There's the green number and the red number. There's the return that it's getting as well as the amount that you're drawing out.
Yep.
Now, the green number or the earnings or the rate of return that you're getting inside superannuation, that's taxed at 15%. Now, it's not as there's a capital gain tax component.
Yeah.
For an accountant listening, we get it, but
it's
basically 15%.
It's technically fund income.
Yes.
So taxable fund income
is
taxed at 15%.
Yeah.
A super fund can actually have accumulated losses that can offset that. It can have not all of the rate of return is. I'm digressing here, but this is just to let everyone know how smart we are. I
was about to say that all you're doing here is you're just showing off. So the capital gains, basically any gains of assets held for longer than 12 months are 10% rather than 15%.
I'm going to give an example here. So the big difference is that, like you said, Dallas, there's 0% tax on fund earnings.
Yep.
Versus 15% tax on superannuation. Now, it's still low rates of tax.
Yeah, but it's
paying 0% tax is better than paying 15%.
Yep.
Paying 15% is better than paying one's marginal rate of tax while they're working.
Yep.
But what it actually does, it's really, really hard to explain a percentage tax on a percentage number as well. So let's say, for example, my fund has, let's make a nice, neat round number. It has 10% earnings for the year, my superannuation fund.
Yep.
What happens is I pay 15% tax. Everyone pays that same tax in that super fund. 15% tax on 10% is actually 1.5%. So it reduces our net rate of return to 8.5%. Mm-hmm. We never see that tax anywhere because the ATO come in and skim that off the top of the fund, and it just reduces our rate of return. So same fund, but I move into account-based pension, same investment strategy, same rate of return at 10%. I get to keep all of that 10%.
Yep.
So it's an extra 1.5% rate of return. Usually when we look at the differences between account-based pension with the same investment strategy and the same super fund provider, a la Q Super, if they're Q Super, if it's Colonial First State, it's Colonial First State. Same brand, if you're in effect. It's usually about a 1% to 1.5% rate of difference that we see. So basically, that tax saving.
Yeah.
Now you may say, what's the difference between a 1% extra rate of return? It doesn't sound like a lot. If you overlay an extra 1% rate of return on your rate of return year in, year out, it's a huge difference. It's hundreds of thousands of dollars of difference over a 20-year period of time, generally speaking. It's a big compounding number that takes effect over time. So that's the main benefit. The other benefit is that it's 0% tax on income drawn once aged over 60. So you're over 60, you're drawing an income from your account-based pension.
So you don't pay.
You don't pay any income tax on that. We've spoken at length about the benefits of this in previous podcasts. The other beautiful thing about that is it actually doesn't even show up on your tax return anywhere. So you can earn other types of income, such as part-time work income that doesn't push you up into higher tax brackets. So two main benefits of account-based pension: 0% tax on the fund earnings, increases the after-tax rate of return by about 1 to 1.5% in most years that we see, depending on the rate of return. 0% tax on income drawn from the pension once aged over 60. So
those are the two main advantages. I think there's a point that you've made here as well, Michael, that is an advantage is your money locked up forever? And the answer is no. So, and we'll talk a bit more about, you've got answers to the next part of that, which is how is that income normally distributed. But basically, once you've met the conditions to have an account-based pension, you can draw that out in part or in full at any time. So there's no limitation on how much you can take out. So you can take lump sums out sort of as needed or as required. Now, that ties into the other part of it, which is, because of that, it's not a guaranteed an amount and a guaranteed income. So if you do take lump sums out, obviously that just reduces the account balance, and so you're more at risk of running out of money. But that's sort of another advantage, is that once you're in that account-based pension, you get the best of both worlds, which is that you've got it all in that tax-free structure, but anytime you need to get that money in part or in full, you can just draw that straight out. And as you say, if you're over age 60, there's no tax on that, and there's no limitation on how much you can get out.
So one of Darren's specific question was, how is income normally distributed? So it's very, very flexible. So it all depends on the actual brand or the account provider, I guess. But most account providers will allow you to choose fortnightly income, monthly income, quarterly, half yearly, or once per year, as well as sporadic income if needed.
You can take additional top-up amounts as needed.
There are minimum incomes required to be drawn. So up until age 65, the minimum is 4% of the account balance. It's currently, in the remainder of 2021-22, it's halved to 2% because... which is probably not a point to gloss over. What the government, we've seen them, these are government legislated percentages that you need to. So if you're under 65, you need to draw 4% of the account balance as an income every year. And people ask me, why do I have to do that? Because it's the law. What it is the government, because they're giving you 0% tax. They want you to actually draw an income from it. They don't want you to build up.
That tax-free.
They don't want you to compound $1 million into $2 million into $4 million. They want you to actually start taking some income. So there are government mandated levels. The government, in times of negative volatility, such as we saw with coronavirus, they generally make an exception. And in this case, for 2 financial years, they halved the minimum amount that you need to draw, so that if you didn't want or didn't need that income, you could allow your account balance to recover a little bit better. But generally speaking, it's 4% of the account balance up to age 65. 65.
Yeah.
It then moves up to 5% between 65 and age 65 and 74, and then it goes up again. So as you get older, the percentage that you need to take increases. Yep. Again, that's probably it's another thing where people say, "Oh, what I'm going to be forced to draw in the future is far in excess of what I'll be able to or what I'll need to spend." And we say, okay, well, you don't need to spend it. You need to take it.
Yes, out of that.
But you don't need to spend it.
Yep.
So you can actually start to build that back up into superannuation if you do, if you meet the age-based or work test requirements. And if not, into an investment. But you do have to take an income. It's nice and flexible. You can start off at quarterly. Yeah. You can start off at...
I guess my thoughts, like practically how we normally recommend this is that it's and we've touched on, I think there's many podcasts we've touched on different ways to draw an income in retirement. But for a lot of people, for a lot of our clients, I would say it's we are setting this up as a fortnightly thing. Most people get paid fortnightly, so it's a nice, neat thing where you get to retirement. Okay, you stop. You basically just turn the tap on, and you're getting a fortnightly payment out of your pension account. So that's sort of normally one strategy for other people where they might be instead have a sort of a separate bucket of cash. They might have $100,000 or $200,000 in a bank account. We might do that as a yearly thing where they basically draw their fortnightly or weekly amount like a paycheck out of their bank account, and then only once a year take a bigger amount that tops that up. But basically, that's a part of what we're in that last couple of years leading up to retirement. We're looking at that with people as to, not just what's the theory of what is how much income are you going to draw, but practically, are you going to draw that out on a fortnightly basis out of your pension account, or are you going to be taking that out of your bank account and then topping up your bank account once per year? Yep.
Yeah, and it's a matter of personal preference.
Yeah,
and it's a matter of actually what works best.
Well, I was about to say it's not it's a matter of personal preference, but it's also a matter for us of our clients. By the time they get to that point, we know what they're like. There are some clients that we have where, if they were to take their yearly payment once in July, by about November, they would have probably burnt through that money. And so those people, it's best to take it as a fortnightly amount and just go like a paycheck. That's how much you've got to spend each fortnight. For other people, they've sort of maybe run a business in the past and they're used to having used to lumpier sort of bits of income and that kind of thing, and they might do that as a yearly thing. There's a few different things there, but it's really around going how best. I guess the way that we normally think of it is that you want like a seamless transition there of how are you used to spending money while you're working and receiving an income while you're working, and then let's just continue that on throughout retirement.
Yep. Another specific question from Darren is, do you constantly need to sell down shares? So, yes. The answer is yes. Yeah. Look, let me talk a little bit more about that, and it sort of leads on to the protection that you're afforded by being in a pooled superannuation fund as well, because what a pooled superannuation or a pooled account-based pension in this example does is it merely just pools many different members' monies together for efficiencies of scale, generally speaking. So you're in a much larger fund, of course. If you've got $1 million in a fund, you own a percentage of that fund, and the much larger fund that you're in basically pools your money together and pools other people's money together.
Yep.
And gets those efficiencies of scale.
Yeah. So what you mean by that is if you've got $1 million in your account-based pension, there isn't someone going and buying and transacting just on your shares. What they're actually doing is they might have $30 million or $50 million in the asset, in the investment option that some of your money's invested in, and they are going and transacting, doing all that, and then basically spreading the cost of those transactions.
They are, yeah. Now, how those pooled funds work? If I own, for example, it's always units. You own units, which think of those as shares as well. but you own units in the fund, and it has a unit price. So if I own 1 million units at a hypothetical unit price of $1, it's just simply the value that I hold in the fund is my unit holdings, 1 million times the current unit price of $1. It means that I have $1 million in the fund. Now I'm a legal owner of a percentage of that larger fund. So
that's a good point, because I think that's people's concern is, well, what if that fund goes broke? But you are the owner of your percentage of those shares that are held by the fund.
That's right. So any good pooled trust structure, and that's what this is, a pooled trust structure, means that the unit holders are the legal owners of those assets. So if the super fund that's running this fund for you goes broke, they can't sell any of your units or use any of your shares.
Payroll or anything like that. Yeah.
The way that I explain that is that the super fund really is very similar to a rental property manager.
Yep.
So if you use a local real estate company to manage your 5 rental houses, for example, that you're just putting them in charge of actually making your life a little bit easier.
They handle those transactions.
They're handling transactions and doing certain things
the property
now.
And you own the rent as it hits. So it basically goes into their trust account. Yeah. And they transact within there, but it's your money.
It's your money.
Yeah.
Of course, if they go broke, they don't have any claim on your houses.
Yeah.
The same methodology works here. The same structure works here. You're the legal, the members and the unit holders are the legal owners of that larger fund.
Yeah.
Now, most pooled account-based pension funds compulsorily reinvest fund income, such as dividends, back into the fund. So imagine, forget the smaller balances. Imagine the fund as a large fund, and let's say that it has, just for simplicity's sake, it has $100 million of funds in the top 200 companies in Australia. Again, for simplicity's sake. And there's all different members that have different pieces of that $100 million fund. What would happen is that if the dividends are roughly 4% for that year, that larger fund gets paid $4 million in dividends for their $100 million
cash payments from
those. Cash payments.
Yep.
That cash actually hits the balance sheet of the bigger fund.
Yep.
And the value of each person's units is always the total fund assets divided by the unit holdings or your unit holdings. So, in that example, if the unit price was $1 and the fund received a 4% dividend, it compulsory reinvest it for you. The unit price goes up to $1.04 with that dividend compulsory reinvested. Now, if you do want to, when you take income, yes, you are selling units.
So I guess,
but it doesn't matter.
Yeah,
it doesn't matter. It's 6 of one, half a dozen the other.
The way that you think about it is like what you've just touched on there, Michael. Like the practical structure of the actual pooled account that all that is in is sort of one layer. If you look through that, I know you hate the X-ray in sort of thing.
It's a really good describing word. Though. So
if you X-ray it in, you're basically going where we just said, like, do you have to sell it? Yes, because what you're doing is if you take money out of your account-based pension on a fortnightly basis, what you're actually normally, and this is where we'll touch on this a bit. You can choose which investment options you actually take that money out of. But essentially, if you are taking that out of your investment options that are invested in Australian and overseas companies, you are essentially each fortnight selling some of your shares in those companies. So that is practically and logistically it's happening via those units, but behind the scenes that is basically what's happening there. And so
you are, and the people become a little bit concerned about that, and they become concerned for no reason.
Yeah.
What they're concerned with is the day-to-day fluctuations, the week-to-week fluctuations, and they're thinking, okay, if the price is down by 10%, 10%, for example, and I'm selling some of my shares, I'm a little bit concerned about that.
Yep.
Well, there's dividends getting paid in all the time on their behalf, and they're reinvesting and they're buying in at 10% down as well. So it sort of it balances out in the wash. There's no disadvantage to actually selling units down. As opposed to the alternative, which would be to having the dividends paid into a segregated account and you're drawing your income from the dividends and then only selling units if you didn't have enough to cover your income and dividends. But it's all over time, 6 of one, half a dozen of the other.
And I think the overarching thing, and I don't want to put words in Darren's mouth here, but the overarching thing here, or the concern that I think a lot of people have, and I'm guessing that because we've got another listener question here, which is actually about this concern, which is that if I've got all my money invested in those Australian overseas companies, and I am taking money out of that fortnightly, that's fine for the smaller fluctuations. But I think the big concern is, well, what happens if there is a bigger drop and I'm company prices are down by 30, 40, 50%, and I'm taking my money out each fortnight, and that's a valid concern, because if those company prices are down by 50%, every fortnight I basically have to sell twice as many shares or units in order to get the amount that I need. And so that's where you then get into the separate part of the planning here, which is having a small amount of your retirement savings set aside in cash within your account-based pension, so that when those bigger drops happen, you can actually start to draw from that. But I won't go into too much detail because we've got a separate listener question about that. So
we do. So wrapping up, I guess that's
very nuts and bolts for you. Darren asked for the nuts and bolts there of what happens at day dot of retirement, and I think you've given a fair bit of the technical detail there.
Yeah, so just in a really quick summary, first of all, you need to meet one of those preservation conditional releases to be able to do that. So the general ones are age 58 and permanently retired, you have to be born between 1st of July 62 and 30th of June 63. Attain age 60 and have ceased an employment arrangement since attaining the age of 60. Permanent incapacity, attained age 65. You've met a conditional release. How is income distributed? It's really, really flexible. Fortnightly, monthly, quarterly, yearly, half yearly, at the very latest once per year. Sporadically if needed. There are minimum income requirements. 4% up to age 65, 4% per year you need to take out. Currently reduced just for the remainder of this financial year to 2%. 5% between ages 65 and 74, and then it goes up from there. The benefits, 0% tax on earnings and 0% tax on income drawn after age 60. And we just covered off on the selling down of shares. So hopefully that gives people a bit more of a detail of a nuts and bolts understanding of it.
And that's one of those things where you go, it's funny because some people really want the detail. I always joke about this because when we're doing this, I'll often draw a circle and go, okay, well this circle here, that's your account-based pension, and people I'll sometimes say to people, do you want more detail about how the circle works? Nah, just it's a circle. That's fine. It's an account-based pension. It's good. You don't pay any tax. It's a good circle. Okay, good circle. That'll do. But some people do want more detail around that. But I guess that's, like you say, I think the point that's interesting here is that, or the way to think about this is that we talk a lot about preparing for retirement, and I think what's dangerous sometimes is we can approach it with a view of, as Darren said, there's a day dot of retirement when you reach a certain age or a certain amount, and then yes, most of the hard work is done by then, but that's only the start of it. You know, we're getting to the point we're trying to get to that age or set amount that we need in retirement savings, but that's only part of the battle. We then need to make sure that we are doing everything we can in terms of that structure so that we're paying the smallest amount of tax possible. We're working that money as hard as we need to, or as we should be, and that we're not spending too much money, because that's the key point I think we mentioned earlier, is that it's not, the model of retirement savings in Australia is not it's a contribution model rather than a defined benefit model. So you have an account behind the scenes and that's exactly the way we think of it, is green numbers, red numbers. Green numbers going in, red numbers coming out. Now, if you're spending, it's no different to when you're working. If you're spending more than you're making, you're going to be going backwards and you're going to be running out. And so, getting to that point of retirement, getting into that best, most tax effective environment, and then making sure that you're not going to run out is the key.
Thanks for listening. Thanks for your question, Darren.
Thank you for listening to the Money Over 50 podcast with Money Over 50 financial advisors. We look forward to catching up again soon.